From New York City, for our viewers worldwide, I'm Katie Greifeld. Bloomberg Real Yield starts right now. Coming up, the U.S. labor market shows varying degrees of strength ahead of tomorrow's payrolls report. Meanwhile, private credit fears return as more companies limit redemptions, and U.S. high-grade bond sales top $1 trillion for the year. We begin with the big issue, an economy that appears to be heating up.
This economy really is on fire.
The U.S. economy is outgrowing the rest of the world.
Growth is very solid for the foreseeable future.
AI is really the economy overall.
Whatever concern we have about the consumer, and they're still spending.
It's actually a healthier labor market, one of the healthiest labor markets I've seen in decades.
It is such a low fire environment that the people who do need to enter the labor market, they're the ones struggling.
We do see some weakness in your traditional white-collar jobs.
The payroll numbers on Friday are going to look pretty good.
For the next year to 2 years, we think that inflation is a bit more of a concern.
The bond market still very much believes that the Fed is going to fight this inflation.
You're seeing a bond market that flipped from cuts to the potential for hikes.
No matter what the Fed does, everything else is kind of self-correcting.
Warsh probably will have a tendency to sort of pause, wait, and observe.
And that brings us to our chart of the week. I'm taking a look at the estimates for tomorrow's U.S. jobs report. That lands at 8:30 tomorrow morning. And currently on your headline number, the estimate there is for 85,000 jobs. Of course, a bit of a downtick from where we were in the prior reading. But you take a look at that unemployment rate expected to hold steady. A little bit of a pickup when you take a look at the average hourly earnings month over month, but a slightly different story when you take a look at the expectations for the annualized figures. Now, the signs of strength in the labor market pulling the Fed's focus to the inflation side of its mandate.
I'm more concerned about the growing risks of persistently elevated inflation than the risk to full employment, and that monetary policy may not be sufficiently restrictive to bring inflation down to 2%.
The labor market appears stable and broadly balanced. I'm increasingly concerned that higher interest rates could be necessary later this year to fully restore price stability and appropriately balance both sides of the Fed's dual mandate.
Stuart Paul of Bloomberg Economics joins me on set now. And Stuart, just set the scene for us, because you think about the past week, we've gotten a kind of mixed bag of labor market readouts. You had the JOLTS job openings coming in ahead of expectations. ADP, the private sector, adding more jobs than expected as well. Then you take a look at initial claims also coming in a little bit higher than expected. So how does all of that set us up for what we're going to get tomorrow morning?
I'll just give you the headline figures. We're expecting to see total job gains of about 95,000 for the month of May. We're expecting the unemployment rate to stay steady at about 4.3%. The way that we can really square the circle between increased layoffs and increased hiring, and what we heard from Nancy Lazar, which is that this is a dynamic labor market, it's a robust labor market, and what we heard from Betsy Stevenson, that it's really hard for job entrants. The way to square all of that data is to recognize that the breadth of hiring is actually exceptionally narrow. The pace of the volume of job vacancies is concentrated in just a few industries, particularly professional and business services. As we saw in the JOLTS report, professional and business services was really just about trying to hire some additional accountants in the month of April, but it's concentrated in that industry and a little bit in, pretty significantly actually, in healthcare, which is not subject to major cyclical forces. It's not characteristic of cyclical strength. So when I see a reasonably strong headline pace of hiring, steady unemployment, relatively flat wage growth, aggregate personal income growth that's being swamped by inflation, and a narrow breadth of hiring, the totality of the data just says to me that this is not actually a dynamic labor market. It's a labor market that's really just treading water right now. It's enough to maintain nominal spending growth, but not to generate additional real economic activity on the household side.
In some ways, it's a parallel conversation to the one that we're having in the stock market, that the breadth is narrow. And you think about the fact that, as you lay out, that it's not broad-based hiring that we're talking about. This shift in focus that seems to be underway at the Fed, from the labor market to being more concerned about an uptick, a persistent rise in inflation. Do you think that that's premature?
I don't think that it's premature to devote additional attention to the inflation side of the mandate. in large part because elevated tax refunds and wealth effects are helping to sustain consumer spending in the face of elevated inflation. But this is not a dynamic where real wage growth is helping to propagate consumer spending and generate additional inflation. This is not any sort of wage price spiral or cyclical labor market strength resulting in additional nominal and real activity. This is effectively wealth gains plus a bit of stimulus facilitating the current degree of inflation that we currently have. I don't expect that the labor market as it currently is will support any real material broadening of inflation. And so right now, I think that the question for the Fed is, do low real interest rates lead to some credit-induced acceleration in economic activity, or do low real income growth, low real wage gains help to contain inflation pressures? And right now, I think that the risk is skewed to the latter. I think that that an undynamic and reasonably cool labor market is going to keep a lid, especially on core inflation for now.
Yeah, an interesting dynamic there. Stuart, really great to preview tomorrow's print with you. That is Stuart Paul of Bloomberg Economics. Now let's dig into all of this and more with our roundtable, because we're joined now by Kelsey Berro. She is fixed income portfolio manager over at JPMorgan Asset Management, as well as Deborah Cunningham, CIO of Global Liquidity Markets and Executive Vice President over at Federated Hermes. Great to have you both with us. And Kelsey, I'll start with you sitting to my left. You know, as we were just talking about with Stuart, you parse out the Fed speak that we've been getting, and there is more concern, I think it's fair to say at this point, about the inflation trajectory versus, what's going on in the labor market. Of course, it's not either or. You can be concerned about multiple things at once. But all of that being said, what are you going to be keeping an eye out for at 8:30 tomorrow morning?
Yeah, so I think there's a few things that I'm watching in the jobs report tomorrow. One of them is the jobs diffusion, or the breadth of job growth. So, as we've been talking about in the previous segment, we are still seeing that job growth is fairly concentrated, particularly within the healthcare sector. That's not necessarily cyclical. So I want to see if that job growth is broadening out at all. I think the other thing to be watching is wages. That I think is very important for the Fed. Right now, they view the labor market, even though it's improved more recently, as in an equilibrium and fairly stable. And the reason that they assess it that way is because wages have been gradually trending lower. Despite the fact that, honestly, if you looked at what we thought would happen to wages given the immigration shock over the last 12 months, maybe you would have expected to see more tightness. But I think that you're not, because there is a reasonable equilibrium that's forming. And I would say the last thing is the U6 underemployment rate. That has actually been creeping up more recently. And so I just want to watch if that's going to stabilize or not. But in general, this report isn't going to help the Fed. The Fed is still really concerned about the inflation outlook. And what's really driving the inflation outlook right now is energy. And when you look at the correlation between rates and oil, it's remained very high, even as this conflict has persisted and equities have decoupled from oil.
Well, Debbie, let's talk about that, because, of course, we're weeks away from that June 17th Fed meeting. And you put in your notes that Kevin Warsh, the new Federal Reserve chair, will not be able to deliver a rate cut in June. You're certainly not alone in that opinion. But, I mean, what about the course of 2026? Because there's growing skepticism about whether or not the central bank will be able to lower rates at all this year.
Our outlook internally within Federated Hermes is that will not be the case. There will not be any Fed rate movement at all in 2026. Neither the cut that Warsh might advocate to put into place, nor the hike, which might be what I'd call the number one concern from the regional president standpoint. I do think it's kind of interesting in the context of how the voting is, where the Fed speak is, how it differs to some degree between the voting regional presidents, which tend to be much more hawkish than some of the FOMC regular members. So I think devil in the details in all of it, but it's very difficult, I think, especially with former Chair Powell still in the committee, and although maybe he'll take a back seat, not sure if that's the case or not, the presence in the room will still be an influence that encourages, I think, stability at this point in time when you have indicators that are maybe mixed a little bit.
And Kelsey, of course, we're heading into Kevin Warsh's first meeting as chairman, and we know that he is no fan of forward guidance. He made that very clear, especially in his Senate confirmation hearing. And there's a lot of questions about what the future of the dot plot looks like, whether we're going to remove forward-looking language from the statement, whether or not we're going to get fewer post-decision press conferences altogether. And I wonder, what you think the impact might be into the bond market, weaning ourselves off of that constant communication.
Well, to be fair, the Fed has been shifting away from forward guidance for quite some time now. So actually, this morning, I was looking at the number of words in the FOMC statement, and I was looking back at a few years ago, and there was a lot more words in the FOMC statement back then than today. And that's really just a function of the fact that we're moving away from the zero lower bound, that it seems like less of a possibility, even in the next recession when it does happen. We're not necessarily going to be cutting back to zero. And so a lot of these things that were created for that environment are no longer necessary. And so from that perspective, I think there may be more continuity than people expect, particularly on the dot plot. We know that he doesn't love it, but we also know that he wants to encourage debate. And so I don't know how he can say he would encourage debate and then unilaterally get rid of the dot plot on his own without consulting with the rest of the group. He wants debate, so let's have that debate and decide what to do. But in general, the market is already operating in a data-dependent framework, so forward guidance has kind of been out the window for some time now.
And, Kelsey makes the good point, Debbie, that you think about the job of the chairperson. You basically, it's half political in a sense that you have to work with the rest of the board as well. The chair is just one vote among several. And, I wonder if you think that we're heading into an environment where we are going to see maybe less words being spoken, less words being put into the statement, and also perhaps more dissents.
Well, I think we really have to judge on what evidence we get on that. Certainly, the talk around it would lead you in that direction. I think to some degree, the press conference after this meeting in a week and a half may be telltale as to what signs or what expectations we might have going forward for the rest of the year for this type of guide. But I also think what this sets us up for is more from a dissension standpoint than we've had historically. Even just the last meeting, which was obviously still under the Chair Powell guidance, you still had many more dissenters. I think it was the largest number since 2012, something like that, or maybe it was even longer than that. But in any case, you had regional presidents that were dissenting on verbiage, not the actual outcome and the vote of the meeting, but verbiage. And then you had Stephen Myron, who's on the other side of the equation, voting in a different way, but on a dissension basis. So I think what you're going to see is less unanimity in the dissension camp and more reasoning in those dissensions as to why they're dissenting.
Well, less than 2 weeks ago until that debut Fed meeting for Kevin Warsh. It should be a fascinating one. Kelsey Berro of JPMorgan Asset Management and Deborah Cunningham of Federated Hermes. Great to have you both with us to kick off this week's show. And still ahead, Blackstone caps redemptions from its flagship private credit fund. We'll talk private credit next. This is Real Yield on Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for a moment of interest, and that is that redemption requests are back in the headlines this week. And for the first time, Blackstone has limited withdrawals from its flagship private credit fund. Investors had sought to pull 10% of the shares. And this week, we spoke with Oaktree's Christina Lee about the stress in the space.
I think there's been a lot of managers that had a pressure to deploy. And when you have pressure to deploy, less volume of deal flow, that typically means you're going to be less selective or you're going to kind of loosen your underwriting. And I think that's been where private credit has been because this asset class has been growing. I think we're finally kind of in a stress test. We're mature now. And so I think this is where you're going to start seeing differentiation between managers.
Let's get into Blackstone and the other redemptions this week from Cliffwater and from Partners Group. Bloomberg's Olivia Fishlow has been covering this story from the start. She joins me now. So it's interesting. We're starting to see these redemption requests roll in, and it seems like we're actually this quarter seeing a lot of these shops enforce that 5% limit versus last time.
Definitely. I think we're in the next stage of the redemption window. So we did see many elevated requests last time, a lot of funds capped, and it seems like everyone so far will cap, and I think people that we've spoken to expect that to continue for this quarter.
And it's interesting when you take a look at Cliffwater in particular, their private credit fund. As I mentioned, the investors had looked to pull about 17% of shares or so. That's actually more than what we saw last quarter. Last quarter, the requests were for roughly 14%. So is that the expectation that we're going to see bigger requests this time around, or is it really idiosyncratic?
I think the expectation has been, from what we've heard, that this quarter will have elevated requests compared to the last quarter. And that's just because the amount of concern around the asset class, but also because investors that didn't get out the prior quarter are going to resubmit and get back in that queue.
Well, let's also bring into this conversation Jason Dillow. He is the co-head of U.S. private credit and head of U.S. opportunistic credit over at Man Group. Jason, great to have you on set with us. So I do want to talk about the opportunities, that part of your title, but let's first start with sort of the mood music in private credit right now, because last quarter the sort of narrative was very much that these are liquidity concerns. These aren't necessarily fundamental concerns. And I wonder whether that logic still holds true today.
Yeah, it's a great question. And I think the one thing in private credit that I'll state up front that people sort of miss sometimes is private credit is not a single asset class. And so there are many ways to invest capital and express risk in private credit. And so in markets like this, where there's a little bit of hair around the market, things are still generally pretty well bid. We look to play offense in defensive assets. So areas where we're finding a lot to do, for example, off the run, non-correlated niche assets. And examples are tax receivables, dividend withholdings, royalty or royalty-like payments. And why we like these assets is, let's say we enter into a period of volatility in broader private credit, or we enter into that what we'll call the world we're worried about. So inflation, recession, some form of market turmoil. It doesn't change 1 cent of how much cash we get or when we get that cash in these assets. And in many of these smaller asset pools, you can structure in profit participations and monetization upsides. So playing defense in a challenging market against non-cyclical assets and participating in the upside along the way.
Talk to us a little bit about valuations. You know, how has the story there changed, especially as you think about the past few months? As you said, I mean, private credit, it isn't just one monolith that we're talking about necessarily, but have you seen valuation opportunities open up regardless?
So I'd say let's bifurcate private and public credit, so tradable bonds and loans. So in tradable bonds and loans, you're seeing that have and have-nots market from a pricing perspective. And the have-nots are all the places you'd expect to see them, right? Software, building products, cable, et cetera. And I think those capital structures, they're going to be challenged. And you're seeing that in market prices in tradable securities. There definitely is still some catch-up to happen in private markets. And you're not seeing that liquidity function hit yet. So no one is forced to sell these assets, so they're not selling these assets. And there's a general sense in private assets broadly where folks are loath to take realized losses on private assets. So I think where we will see private opportunities in assets will be when there comes to some forced selling mechanism. And at that point, you know, what are you going to sell? You're going to sell your best assets. And sometimes those are assets that candidly should be worth par, and maybe they take a discount on those. So I think that's an opportunity. We're still very early stages in that process, and so we'll be looking for those examples. But I think the opportunities today, in terms of actionable opportunities, are much more in the tradable markets.
When would you expect those opportunities to start coming for the loans that you would look to buy?
Yeah, so back in the haves have-nots question, it's is it refinanceable? And I'd say let's just take software as an example. And so software is there's a kind of a double whammy effect on software right now, right? The one is the loan to value effect. So the value in public markets of these companies have come down quite a bit. And so the gap between like the amount of debt and what the cushion is from a value perspective has decreased significantly. So that's Whammy 1. And then Whammy 2 is the increase in rates. And so most of these deals, or a lot of these deals, were done in 2020, 2021, effectively in zero interest rate environments. So let's say you issue debt, rates plus 3.5%. You're paying kind of 3.5% in interest. And all of a sudden you're paying like 7.5%, 8%. And not all of these business models were structured or have the economic flexibility to be comfortably paying that amount of interest expense. So that double whammy, it's going to come when things come due. And so are these extensions? Are these somehow refinancings? Are they bankruptcy filings? And I think that's when you're going to really see the rubber meet the road in the space.
The rubber meet the road. I do want to talk a little bit about what we heard at Bloomberg's credit forum that happened yesterday. And it seems like there was a lot of warning on a shakeout coming, maybe lines a little bit with what you're saying. And one of the sectors, the industries that was called out was sort of cable and broadband providers. I mean, how specific are you looking here when you think about sort of the sector level?
So there are certain sectors that have more problems than others. I think what's probably the focus around cable broadband was really a lot of the timing of relatively high leveraged transactions in the space, which a lot of those transactions were done again in that 2020, 2021 timeframe when rates were quite low. And so they're starting to come due in the next year or two. And again, the appetite doesn't feel like it's there to regular way refinance these businesses. So I think that's where we'll see the opportunity set in that particular sector, cable and broadband. And I think again the same is true. There's a lot of rhyming between these sectors, which is not untraditional in credit, right? Like kind of nothing happens until everything happens.
That's true in so many things in life, Jason. Great conversation, as well as Olivia. That is Jason Dillow of Man Group and Bloomberg's Olivia Fishlow. This is Bloomberg. Up next, it's the auction block on Real Yield. This is Bloomberg. I'm Katie Greifeld. This is Bloomberg Real Yield. It's time now for the auction block, where we highlight the credit issuance so far this week. And even after just a few days this month, U.S. high-grade sales are already on pace to be the busiest since June 2020, rather the busiest June since 2020. Anyway, this week surpassing forecasts thanks to deals from such companies as Santander and Duke Energy. In U.S. high yield, a data center tied to CoreWeave raised $900 million, joining a wave of junk issuers tapping markets to fund AI infrastructure. Companies tied to the sector have raised more than $27 billion in this market so far this year. And QXO had a $6 billion loan and high yield sale this week to help fund its deal to buy Top Build. It was split between a $3 billion loan and a $3 billion junk offering. The financing package drew $20 billion in orders. And speaking of high yield, this week at the Bloomberg Global Credit Forum, we spoke about how AI is affecting issuance.
20% of high yield issuance is AI related. That compares to 12% in IG. So again, last year there was very little being done in high yield in around the AI ecosystem, and now it's accelerating.
There's a race to buy it right now that's different than you saw kind of 6 months ago. It's interesting to see the herd really start to chase it.
Credit has still languished, and we expect that to continue. Now, that's not to say that it can't have a better second half, but I do think there's some pockets of opportunity. But this is historically a tough time to be in credit.
Well, let's dig into all of this with our credit roundtable. Sonali Pier, she is multi-sector credit portfolio manager over at Pimco, as well as Meghan Robson. She is head of U.S. credit strategy over at BNP Paribas, both joining me on set, which is a treat. And Meghan, I'll start with you because I'm taking a look at your notes, and you said that you're still bullish. You still forecast U.S. investment grade spreads to tighten to the 60s, which certainly we're getting tight here. And I wonder, how that intersects with all of that issuance that we've been talking about.
Yeah, so I think we're out of consensus in terms of thinking that spreads can continue to grind tighter, and there's really three pieces to that view. I think the first is more medium term, our credit cycle view. We think we're mid-cycle in credit markets still, so despite some signs of re-leveraging, debt borrowing, debt surging in certain sectors that we've just talked about, overall, there's a lot of sectors that are still very rate sensitive. So I think the supply absorption is still manageable. And then also, if you look at more tactical, if you look at investor positioning is not yet extended in credit markets. We think we're just back to more of a neutral level, but there's still room for investors to add here. So for now, we think yields will continue to dominate in terms of the demand picture, supporting demand, and then keeping supply at bay from those type of sectors and issuers that are a little more sensitive to the overall absolute level of yield borrowing.
And that's the evergreen debate, right? Yield versus spread. It seems like yields certainly are still attractive here. But Sonali, I want to talk about issuance with you as well, because that feels like the big topic when you talk about these public markets. And as Christina Minnis from Goldman was saying, it's not just an investment grade story. It's a high yield story as well. And I wonder, how you're thinking about all of this issuance coming through from especially the hyperscalers in a tech sector that classically hasn't been as active when it comes to the primary markets.
Yeah, it's been a considerable amount of issuance. And when we look at this year's year-to-date issuance, it's already outpaced 2025's with respect to the AI-focused issuance. And none of these markets are big enough for the amount that needs to come. So we do expect issuance across asset classes, high yield, investment grade, asset-based securities, direct lending as well. And, I think it's providing opportunities for us to look at it and see where there's relative value, where there's either structure or covenants that can kind of help advocate on behalf of our investors in terms of the right type of issuance that's aligned with the type of credit exposures we're taking. So we do expect this issuance frenzy to continue. And in levered markets, to some extent, they've had much less net supply in recent years, that this is somewhat of a welcome change. Although, again, being selective is going to be critical here.
Well, let's talk about how this impacts demand overall, because some numbers here, as we've been talking about, you think about U.S. investment grade bond sales, they hit the $1 trillion mark earlier this week. That's the quickest that they've reached that milestone since 2020. Then you think about U.S. Treasuries. The U.S. Treasury has announced around $1.4 trillion in new cash this fiscal year from Treasury sales. We heard from Apollo's Jim Zelter earlier on Bloomberg Television, basically saying that you're seeing the potential for a long-term crowding out of government debt as you have more and more of this long-duration CapEx boom around the globe. And I wonder, Sonali, to start with you on that point, how, if that's a concern that you share, that demand for, this very top tier rated paper could crowd out demand for government debt?
Yeah, I think there are different types of debt, right? And also remember, too, we're talking about AI, tech-related debt, where as you go out the curve, you start to worry about obsolescence. And that's where, again, when we talk about the structuring of this debt is so critical, right? So meaning having amortization alongside, say, if your security is GPUs or the like, right? There's ways to structure this that the credit itself is attractive, getting a meaningful pickup for if there's complexity in the structure as well in terms of spread. In terms of governments, the long end is we're seeing under pressure to some extent with the heavy deficit financed, financing of tax cuts and the like. And, that's, I think, pressure independent of what we're seeing with corporates. Although the sheer amount that corporates need to issue, there will be those that are hedging, compounding to that.
Yeah, duration is a dirty word. That certainly continues to be the case. And Sonali makes a fair point, of course, that it's not an apples to apples comparison, exactly what Jim Zelter is talking about here. But that concern does exist, Meghan. And I wonder, how you think about how this might impact demand across these two different asset classes.
Yeah, I think there was more of a stronger substitution effect argument maybe a year ago. So rewind a year ago, before all these hyperscalers started to sell so much debt, there's more of an argument that they had very strong cash position, very low leverage, potentially a credit quality that was more more aligned with a sovereign borrower. But now, fast forward this year to date, we've already seen 160 billion of borrowing. There's risk of potential downgrades. Of course, they're starting from very high and very strong credit ratings, but I think there is that story as well in the background. But for now, I think demand remains incredibly robust for the hyperscaler issuance in particular. It is skewed towards longer dated, so we've seen about 70% of the issuance come in 10-year plus. And it's not just domestic. You have foreign buyers as well that are finding this very attractive and a place for it in, for example, in Taiwan, life insurance policies. Life insurers have been a large buyer of a lot of this debt.
Mm-hmm. Well, let's talk about the other big story out there, and that's what's happening in private credit. And I wonder, what the read-through from what we're seeing in pockets of the private credit market, whether or not, that extrapolates into the public markets. And Meghan, I would love to hear your thoughts on the ripple effects, potential ripple effects.
So private credit, no arguments, it's definitely the area of vulnerability this cycle. For now, we see kind of deterioration is moving very slowly, and it doesn't disrupt our overall constructive view on public markets. And I think you're continuing to see headlines around redemptions. We think that will continue with the BDCs. They don't have to meet all of the redemption requests. And we think that they will continue to cap those redemptions as they're permitted to do. I think the good news is, so far, why is all of this a risk? It's because people are worried about software and obsolescence, which Sonali mentioned earlier. What did we learn from earnings? So far, software, we got good news from earnings. So guidance was pretty good. People were very forward-looking in terms of addressing some concerns of investors. So we don't have that hard evidence yet that obsolescence is spreading across the software sector. On the contrary, and so for now, we are less worried and think the risks in private credit are contained in terms of the fundamental piece.
Yeah, you talk about that strength that we've seen in earnings certainly has manifested in the equity markets and in the public credit markets. But Sonali, the question is still out there. I mean, are you worried about any potential contagion there? Because at least when you think about, some of these redemption requests, there are at least liquidity concerns.
Yeah, I think what we're seeing so far is a re-rating of multiples, right? Deals done in 2021, multiples are coming down considerably. But still at this stage, it does seem a bit idiosyncratic, industry specific, and not yet systematic. I think the important piece here, though, is as we see convergence between the public and private markets from a financing perspective where issuers are having more choice, we are not seeing convergence from a liquidity perspective, right? There's a lot of hurdles here to get private credit to be liquid. For example, differences in access to information, differences from whether the issuer will approve the transaction to a new buyer. And these are hurdles that mean it's very difficult for it to become liquid. And I think in this, where we are in the cycle, and the opportunities set ahead, we are favoring having flexibility and liquidity in the portfolio construction.
Well, we're up against the clock. Have to leave it there. So enjoyed this conversation. That is Sonali Pier of Pimco, as well as Meghan Robson of BNP Paribas. And if you can't get enough talk on credit, check out the Bloomberg Credit Edge weekly podcast on the terminal and wherever you get your podcasts. Now, still ahead on Real Yield, Illinois passed its largest budget on record, which includes most of the items that Governor J.B. Pritzker laid out earlier this year. We'll take a closer look next in our Muni Moment. This is Bloomberg Real Yield.
We're just about halfway through the trading day in New York. I'm Nora Melinda. Let's take a look at your midday movers. First up, a sell-off in tech stocks is easing in the U.S. session. The Nasdaq 100 now sitting just 0.5% lower on the day. At the same time, oil is moving lower as a conditional ceasefire between Israel and Lebanon raises hopes for a broader deal involving Iran. Brent crude is trading around $95 a barrel, while WTI hovers near 93. In tech, Broadcom is tumbling for its worst day in 16 months after its AI sales forecast failed to meet investors' high expectations. Even with today's drop, shares are still up nearly 20% this year. And finally, Meta is moving higher after Instagram introduced Instagram Plus, a new subscription offering aimed at powering users with access to exclusive features and deeper insights. The service begins rolling out globally today. Those are your midday movers. I'm Nora Melinda.
Welcome back to Real Yield. It's time now for our Muni Moments. And we start with Illinois passing a record-setting $56 billion budget for the 2027 fiscal year as Governor J.B. Pritzker prepares for potential federal funding cuts. Let's bring in Bloomberg's Shruti Singh for more now and set the scene for us. I mean, talk to us about the significance of this passage.
So the Illinois budget is closely watched because from 2015 to 2017, the state had a budget impasse with the prior governor and didn't have a budget enacted. And so the passage of the Illinois budget is something that is watched closely by taxpayers as well as investors. So Governor J.B. Pritzker came into office in about 2019, and since then the state has passed budgets on time. But it comes down to the wire. This one was passed on the deadline overnight from Sunday into Monday morning. The deadline to pass a budget by a simple majority was May 31st, which was Sunday, and they worked through the night to pass this budget.
And I want to talk through some of the different factors that led to this passage, because I believe the Chicago Bears somehow played a role here. Just explain that to me.
Sure. So the spring legislative session is a key time when the legislature passes or votes on the budget. This spring session, there was also another related, but not an item that was part of the actual budget, but something that lawmakers were considering. The Chicago Bears over the last 4 years have been actively looking to see where their next home might be. They've been playing in Soldier Field for decades. They're looking to build a new stadium. A couple of different options that they've laid out are, over the last several years, they've been looking at either the city of Chicago building something new along the lakefront, or at a site that they own in Arlington Heights, which is a suburb of Chicago. Most recently, over the last few months, they've also been looking at a site in Northwest Indiana. The Indiana legislature did already pass an incentive package. Illinois lawmakers have been negotiating and talking about what they want to do for the better part of the last 2 to 3 years. This was something that was taken up in the fall session, but then also came up again in the spring session because no deal has been struck that's officially been voted on or enacted. So this spring session, there was a couple of different items that were brought up. One was passed by the House that took a look at property taxes for this particular site that the Bears are looking at in suburban Arlington Heights. The Senate, on the other side, was looking at something where they could create a financing authority for individual municipalities in Illinois. Now, the House passed its bill, the Senate passed its bill, but the two chambers have not voted on each other's bills. And so that was a challenge, and so nothing has moved forward. The Bears have said they will make a decision probably sometime later this summer in terms of where they want to go from here.
Well, it's just fun and fascinating how it all knits together. Shruti, great reporting. That is Bloomberg's Shruti Singh. Time now for another Muni moment, and this time we go to New Jersey because Princeton University's endowment is backtracking on its pledge to divest from publicly traded oil and gas companies 4 years after it said it would exit such holdings as a way to move towards a net zero portfolio. Here to report is Bloomberg's Janet Lauren. And Janet, I mean, a lot has changed over the past 4 years, but why the backtrack and why now?
Well, I think you just heard it on the Muni Minute with $95 a barrel. Energy is making a lot of money. And endowments, especially schools like Princeton that had huge allocations of private equity, they're not getting the returns they used to. So they're looking at what can we do? And they said they wouldn't hold publicly traded oil and gas companies, but that doesn't talk about private equity. So you're looking at why would we want to impose a ban on something that's giving some nice returns? And they said it's not going to really help our net zero goals anyway.
Talk to us about what the reception has been like, because as you lay out endowments, I mean, they need to make returns, and you know, these oil investments are making a lot of money at this moment, but I mean, has there been any backlash?
Well, I think in some ways it's a very different environment, as you talked about, than 4 years ago. A lot of schools had been talking about this. Again, not divesting from publicly traded companies is a really easy thing to do. So is getting back into them. You're just literally buying stocks. But Princeton is their president has talked about financial struggles lately. They're not expected to generate the same kind of killer returns that they had been known for. Again, you've got more than 40% in private equity. It's not returning as well. And Princeton is really unusual that it's very dependent on their endowment. It makes up about 65% of their operating budget. So even if it's $36 billion, they actually really do need that money. And it's hard to wrap yourself around, well, they're so rich, why do they need this? But they just need to be generating returns.
Well, very interesting sign of the times. Great reporting. That is our Janet Lauren of Bloomberg News. And still ahead, my final thought, the May payrolls report on deck. This is Bloomberg Real Yield.
Right now, policy's in a good place. We are prepared to respond either way, whatever the economy brings. But I think giving more forward guidance about what's possible could be misguiding in the end, because we just have to wait for the economy to evolve. Everybody wants to resolve the uncertainty today, but I think that's a mistake, because it will close off our mind about what we really have to look at.
That was San Francisco Fed President Mary Daly speaking last hour on Bloomberg about monetary policy. And that brings us to my final thought. Let's look ahead to the May payrolls report with Anna Wong. She is the chief U.S. economist for Bloomberg Intelligence. A treat to have you on set with me, especially ahead of tomorrow's payrolls print. And, we were talking about with Stuart Paul that you think about the type of hiring that we've been seeing. It's very narrow in breadth. It's a few sectors that are really only benefiting here. And I wonder what that means, the sort of read through into the type of spending we can expect going forward and economic growth in general.
Yeah, so I mean, if you look at the jobless claims data today, well, it's surprised on the upside, but in fact, it's all seasonal due to seasonal volatilities. But the bigger picture is that the labor market has been improving. And it's also broadening. The gains are slowly broadening. And I think in terms of the sectors that's adding job, we have been in this situation with very narrow type of hiring concentrated in healthcare and education. We are now seeing that the hiring is also broadening. So in the last payrolls, we've seen that transportation logistics added a significant amount of people. And I think that is a trend that is going to continue in the rest of this year as the manufacturing and industrial sector is really booming because of defense and also AI.
Right. That's where I wanted to go. Manufacturing has been in an interesting place. We've seen a lot of months of contractions. That has been the story for several years now. We are expecting a slight increase, a slight positive number added to that sector tomorrow. But what are you seeing when it comes to manufacturing overall? You're expecting an improvement, but why is it taking so long?
Well, first of all, industrial production is the most sensitive sector to monetary policy. And when the Fed tightens the interest rate in 2022, that's the first sector that got hit. And so over the last 3 years, that sector is just in pretty much a depression. And now that the Fed, the cuts from the Federal Reserve is working through the economy, this sector is finally recovering. Now, on top of that, you have that dual tailwinds coming from AI and defense sector, which are all demanding for the same type of manufacturing services as well as the same type of industrial commodities. Then you got this really supercharged sector, and we are going to see a pretty V-shaped type of recovery in the industrial sector.
All right, Anna, great to have you on set to preview the big report at 8:30 a.m. tomorrow. That is Anna Wong of Bloomberg Economics, of course. That was Bloomberg Real Yield. And from New York, that does it for us. Same time, same place next week, now on Thursday. And tomorrow, don't miss the premiere of our newest show, Bloomberg Money. It's hosted by Scarlett Fu and Tom Keene.